So what is going on with private credit? Hello friends, welcome back to another video update. Today I want to break down a topic that has been getting a lot of attention lately, and the topic is private credit. Sounds complicated, but let's make it simple as always. Okay, think of traditional lending. Let's start there. You own a business. You walk into a bank, you apply for a loan, and the bank says yes or no. You can have the loan or not. Private credit is really the same thing, except for instead of a bank, the loan comes from an investor, and the loan is negotiated privately. So this is outside of the public markets. These loans can offer higher yields at times, and since they're not traded on public markets, they're actually less liquid. So there's trade-offs, of course, like everything in life. So why has this space exploded in recent years? Well, because big banks, number one, have pulled back from lending due to tighter regulations. This really started since the financial crisis. So they are being more selective. And number two, investors are searching for higher income. And this came from years of low interest rates. So private lenders have stepped in to fill the void. They stepped in to fill the gap. Now, the headline everyone is asking about, are we setting up for another financial crisis because of private credit? It's a fair question. So glad you asked, but no. The answer is no. We don't think so. Not at this time, especially nothing like the 2008 financial crisis. Here's why. Let's look at the key differences between private credit today and the mortgage crisis in 2008, kind of an extreme example. Number one, the size of the market. In 2008, mortgages were enormous, about 70% of the entire U.S. economy. Private credit today, about 1.3 trillion, or 4% of the economy. A much smaller slice, which means less systematic risk. Number two, leverage. Back then, banks were leveraged 20 or 30 to 1. Some banks, I won't name them, were 40 or 50 to 1. It was not good. Today, most private credit funds are closer to 1 to 1. And even the more complex vehicles are usually 2 to 1. So less leverage equals less fragility. Okay, number three, who holds the risk? Who holds the risk? In 2008, mortgage-backed securities were widely distributed across the entire financial system. We didn't know it at the time. But private credit today is mostly held by large institutional investors and also high net worth individuals. So the institutions and these individuals, they understand the risk and have the capacity to absorb them. That's the idea. Number four, liquidity. Mortgages were extremely liquid until they weren't, but they were extremely liquid. Private credit is designed to be semi-liquid from the start. Most funds will limit withdrawals around 5% a quarter is kind of the limit, and investors know that going into it. Mortgages were nothing like that. Now, while some funds have slowed redemptions recently, that's been in the news, we haven't seen forced selling at steep discounts. That is what typically signals real distress. Okay, number five, contagion risk. In 2008, stress spread everywhere. High yield spreads blew out to over 20%. Today, high yield spreads are around 3%. So that tells us the broader market is not flashing warning signs. So yes, there are some cracks in parts of the credit markets. We're watching this, and yes, private credit carries more risk than higher quality bonds. But based on what we're seeing today, the conditions simply don't resemble the setup that led to the 2008 financial crisis. We'll continue to monitor this space. It's very complicated. It's very interesting. Keep the questions coming. Love the feedback. Have a great week. We'll see you next time. Take care.